What if I told you that just 3 minutes of math could be the difference between a six-figure payday, a successful commercial real estate investment, and a six-figure mistake and a whole lot of pain? See, most commercial real estate investors, they don't lose on their deals because of a bad market or because of interest rates. What they lose on is they did not analyze and prepare and protect their investment going in right out of the gate. And if you are somebody that's been intimidated by cap rates, net operating income, complex spreadsheets, I gotta be honest, you're not alone. When I was first transitioning from single family to commercial real estate, I would have never considered myself the numbers guy or the spreadsheet guy. But here's the thing, you don't need a finance degree to figure this out. So in today's video, I'm gonna teach you how to break down a commercial real estate deal with clarity, with confidence, and with common sense. So that way you'll know whether you want to walk away from a deal or you want to double down and take it across the finish line. Let's turn this deal analysis into your unfair advantage. Let's dive in. What's going on, wise investors? We are back with another video. And by the end of this one, you're gonna understand the exact process that many seasoned commercial real estate investors use to evaluate deals without overcomplicating things. I'm gonna walk you through some very simple frameworks and steps that you can apply going forward in your own deal analysis. And just to let you know, you're not gonna become an expert in analyzing deals and structuring deals after watching one video. So just understand that by subscribing to this channel, other great channels out there, asking lots of questions, engaging, and just seeing real deal analysis, real time, whether it's somebody else's, getting in your own reps, getting that practice is what's gonna give you the confidence to continue to shore up your weak spots and double down on your strengths. So stick around. We're gonna dive into a real life example after we jump into this presentation. So that way you can understand what it looks like outside of, let's just talk about it in a training, to what it actually looks like in an actual spreadsheet. So without further ado, let's dive into how to analyze a commercial real estate deal, even if you are not a math whiz like I wouldn't consider myself. So before we dive in, let's talk about why deal analysis matters. Well, at the end of the day, knowing your numbers is the difference between winning and losing in the world of investing. And if you're somebody that is going to be investing your own hard-earned dollars and or using other people's money and investing theirs into your deals, then you need to be extremely confident in how you are analyzing a deal, because at the end of the day, we always say you make your money on the buy and you realize it and actualize it over time and when you sell. And so analyzing a deal properly up front and making sure that all of your assumptions make sense, that you're buying it properly on the front end to protect your downside, which again, these are all advanced strategies that over time you're gonna become an expert at. And the goal around deal analysis is just to get repetition, to watch this channel, to watch other investors, to learn and grow through proximity, and also by just getting in a spreadsheet and doing it yourself. I'll finish with this before we move on. I never thought I would consider myself a spreadsheet or a numbers guru, and I still don't. But what I can tell you is no one is gonna protect your investment, your wealth, and or make it for you more than you will. And one of the best and highest ROI skills when it comes to commercial real estate is deal analysis. So be sure to subscribe to the channel. Be sure to drop questions and comments. We got a lot more videos that will go over this. Again, this is just a very high level beginner's overview. But again, it's just to get you in the game, in the batter's box, so you can start at least seeing pitches come across the plate and determining which ones you may or may not want to swing on. So what does really matter when it comes to deal analysis? Well, there's a lot of stuff. It's like drinking through a fire hose, and you're gonna think that it all matters and it all is equally as important. What I'm here to tell you is in the beginning, when you're doing quick desktop analysis, back of the napkin analysis, and I'm gonna show you here quickly in a spreadsheet in a couple minutes, the things that matter most are gonna be your purchase price, the gross income of the asset, the operating expenses of that asset. What are all of the expenses that go into operating this asset so that way you can collect that gross income, right? And then if you were to take the gross income and subtract the operating expenses, that's what leaves over what we call the net operating income, which in commercial real estate is extremely important for determining value and ties into deal analysis, which you'll see here in a second. Now, the financing terms is something that's going to be different for everybody, right? The loan amount and how much money I put down, or what debt I get, what interest rate that debt is going to be given to me at, what amortization schedule, all of those things are going to be different from investor to investor based on my scenario and how I decide to structure the deal, right? So just understand that this is going to be something that will be different for you, and you want to take that into account when you're analyzing deals based on the loan amount that you're going to be getting, the money that you're going to be putting down, the interest rate that you're potentially going to be getting, the amortization schedule. Those are all be things that we'll talk about. But again, these are the things that really matter when you're doing a quick desktop analysis. So a very simple framework to evaluate any deal is, do I like the property type? Do I like the market that it's in? Do I like the location that it's in? Okay, yes. Now, I need to understand the net operating income of this asset. If I take the gross income and subtract the operating expenses, what's left is my net operating income. That's a very important thing that I want to understand, because I am going to use that in how I determine the value or the potential value of this asset. And so based on the net operating income and a cap rate, which you'll understand the formula here in a second, I can then determine the value of this property and how much I may want to pay, how much I may want to get it under that price, how much I may willing to go up to, right? So very important to understand these things to get to a value. And then based on how I am going to invest into this property and how much cash I'm going to have to infuse into it, what kind of return do I want to get on my money? Based on that will help me determine how I back into an offer price and a potential structure. And we're going to stress test this deal for downside, so that way we can protect ourselves against any of the risks that we can actually be proactive about protecting ourselves against, right? We call it building a moat around certain areas of your assumptions. So that way, worst case scenario, if some of these things happened, you're already aware of them in your deal analysis, and you can be proactive in how you plan. Again, a lot of advanced strategy in how you can structure and analyze and underwrite deals. For the sake of this video, we're going to keep it high level and keep it moving. So we want to start with the property type in the market, right? So what kind of asset class is it? Is it a retail shopping center? Is it an industrial property? Is this going to be a mobile home park, a multifamily building, right? If you feel good about that and you understand the asset, right, that's going to be a box that we want to check. Do you like the location that it's in? You might like the asset class and the numbers on it, but it might be in a complete war zone where you don't even feel safe going down there, or maybe a property manager won't want to go down there. So again, we just want to make sure that location, the asset type, the overall market, and then obviously understanding the demographics. Is crime high and trending even higher, or is it low and it's trending downwards? Is population trending in the right direction? Is household income trending in the right direction? Being that you don't want to buy an asset that all of the demographics are trending in the wrong direction, right? So this is, again, just a high level kind of market analysis, asset analysis. Do I like the tenants that are in this property or that I'm trying to get into this property? Do I like the lease structures that are tied to this property? What's the story behind this sale, right? Just some quick and easy questions that you can ask yourself that may determine whether you want to go to the next step or not. But let's assume that you like everything about the asset class, the tenants, the market, the demographics are trending in the right direction. So I think we want to dive into this a little bit further. Next, we're going to start trying to dive in and get clarity around what the net operating income is. And as I mentioned earlier in the video, right, the net operating income is going to be your gross rental income, how much the tenants are paying you. And there may be some other income streams tied to the property. Maybe there is, a local food truck guy that is renting the parking lot for, once a week. Maybe you have a cell tower on the back of the property and they're paying. So get all of the rental income that is collected, your gross rental income. Then we're going to subtract all of the operating expenses. That's things like the taxes, the insurance, management fees, any repairs and maintenance. These are going to be things that are required to operate this property and keep it in a good condition that your tenants feel happy about, so that way they keep paying you that income, right? So once we take the gross rental income, we subtract all of the operating expenses. That is the net operating income. This is what we call the pre-debt service income. So there's no mortgage payments being taken out of this. Why we like NOI, net operating income, is because what I mentioned earlier in the video is everybody's debt could be a little bit different, or how they're going to structure the debt and the equity on a deal could be a little bit different. So what happens after NOI is different for everybody. So we just want to know what the net operating income is of this property if we were to buy it today and take the income, subtract the expenses based on how it's being operated, what's left over. Net operating income is extremely important because that's ultimately what tells us what we think the property is worth. So you're going to take the net operating income and you're going to divide that by a market cap rate. Now, this is something that you can get from a broker, that they're going to basically tell you, right, based on properties like this, you're going to see it sell at a cap rate of this, whether that's a 7 to a 7.5 cap, right? Or a 7.5 to an 8 cap, or hey, properties like this that are really beat up are selling at a 9 cap. So you just want to understand what the cap rate is for a similar type of property. And then based on the net operating income, you divide that by whatever that cap rate is, and that will help you back into what an overall value is. And again, we want to compare this value to the purchase price to determine, are we buying this below where we think the real value is based on this net operating income and the cap rate? Are we overpaying for this? This is going to help us, and obviously using local market data and broker feedback to find the right cap rate to apply to the property that you're interested in is going to be very important when it comes to analyzing the deal. So based on our deal analysis that we have inside the Wise Investor Collective, we use something called the 2-minute analysis. And again, this is just a quick, high-level, kind of back of the napkin, dirty analysis where we're going to take the top line revenue, right? If there's any economic or physical vacancies, then we want to factor that in there to get what we think the net annual income is. And then based on the annual expenses, the operating expenses, whether that's 30%, 40%, and you're usually going to be able to get access to this data and this information, what the income is, what the expenses are, from the listing or from the broker data. They're going to give you all this info, so that way you just have to plug it in, right? And if you don't have it, then you might need to do a little bit of digging, ask questions from the seller, the broker. Somebody has this information. Our job is just to get it and put it in this sheet, right? And then based on that, that's going to tell us what our net operating income is. And then based on what the cap rate is, that's going to tell us, right, what the overall value is of this property. So if this cap rate goes up, well, this number is going to change, right? And if this cap rate goes down, this number is going to change. So again, we're plugging this in to tell us what the overall value is. So to give you a little bit more of an in-depth kind of breakdown of this, when you're doing an analysis, we call it inputs, right? We have information that we're going to input into our analyzer. And based on the inputs we put in there, we're going to get outputs, things spit back out to us that tell us what we want to know, right? So in this quick little analyzer, we need to know what's the potential annual income, what are the vacancies, what is the operating expenses, and then what is a cap rate that we think based on the way this property is, its condition, its income, its occupancy levels. And again, a broker, if you're new, can help you understand what a cap rate is specific to an asset like the one that you're potentially analyzing and looking to purchase. And based on us getting all those inputs and putting it into this sheet, it's going to give us an output, quick output of, is this deal actually close to the number that I'm willing to pay, right? And I'll show you guys in a real life example. But before we dive into that, let's just go over, let's say that, you know what? I think that this deal is worth, I'm going to just go back one slide. They're marketing this deal at 1.3, and I want to get it at an 8.5 cap. And that puts it at 1.2. So I think that, I'm $100,000 less than what the asking price is. I think that based on some of my quick back of the napkin math, I'm going to want to do a little bit of a deeper dive on this deal, right? And so based on that, we also want to think about what kind of cash flow do you want to get, because I need to know what return you're trying to aim for, so that way we can back into that in the analysis. So what's my ROI on the cash that I put in? Now, generally, I always aim for a 10% cash on cash or higher. For every $100,000 I put into a deal, I want at least 10 out on an annual basis. Now, some people, based on what their goals are willing to take less. Some people want more, right? This is why deal analysis is unique and individualistic to each person's goals. So understanding how you can reverse engineer and toggle inputs to get the output, right? One of the outputs being your cash on cash return. These are important things to know, which we'll cover in the video here coming up. So use this. It's going to just take your annual cash flow and you're going to divide that by your initial cash invested, which is going to get you that cash on cash return. And so this is to use it as a metric to compare deals side by side, right? Like, hey, this deal gets me a 15% cash on cash return or a 10% cash on cash return. Whereas this deal over here only gets me a 7% cash on cash return, right? So this gives you the ability to compare deals apples to apples. And again, you have to factor in debt service and you have to factor in your reserve costs to make sure that you know what your all-in cash number is going to be. And therefore, based on the returns that it spits out, whether is that suitable to you or not, these will be things that the analyzer will help you. You don't need to be the, brain surgery, Excel expert scientist that most people think they need to, right? The calculator is going to do a lot of the heavy lifting for you, but we need to know some of those things going in, right? Now, what if things go wrong? This is one of the biggest fears that most people have, and it's totally reasonable. What if one of my tenants leaves and the income drops? Can rents drop over time? Can expenses rise over time? Can you still cover the loan and keep the property cash flowing if you lose one of these tenants or one of these things happens? Well, of course. And this is what we call stress testing a deal, right? What if those things happen? That's why we like to run different scenarios. And in our calculator, that's what we do. We run, hey, what if we just operate this thing as is and it, just stays on course? What if we can get the seller to do some creative finance with us and we can get creative there? What if, we crush it and we hit the best case? You know what? Let's take a blend of, worst case and best case and base our offer on that, right? So we like to use different scenarios to look at different stress test cases, because at the end of the day, the biggest mistakes that you can make as a new real estate investor is to go into this with what we call rose-colored lenses or blue sky scenario. There's never going to be a rainy cloud. There's never going to be a rainy day that hits your deal, and it's always just going to be, sunshine, rainbows, and cash flow. And at the end of the day, that's just not the reality of investing in real estate. So I always like to protect my downside by making sure that my assumptions, when I'm putting inputs in my acquisition price or the down payment percentage of doing less or more, if I need to have more operating reserves on hand than less, if I want to overestimate vacancy or some of the concessions that I may have to give to get tenants in, or maybe the timeline that it takes to get tenants leased up into this property and backfill the vacant space. Maybe the operating expenses I'm going to go a little bit higher on just to be safe, right? Maybe the cap rate that I think I'm going to go a little bit higher to make it so the value isn't as inflated. We want to overestimate where most people underestimate, and we want to underestimate where most people overestimate. These are going to be ways that you can insulate and what I call build in safety nets into your deal. So if and when these things happen, you've already planned for them. And if they don't, guess what? You're just going to benefit from cash flow and from equity growth, but making sure that, again, you make your money on the buy. We just want to be very cautious and conservative because at the end of the day, I want to see you winning here. I don't want to see you, getting into a deal thinking that you're going to crush it, nothing's going to go wrong, everything does go wrong that you didn't plan for or model in, and all of a sudden you're upside down in a deal, your first deal, you're losing money. And guess what? Oftentimes that leads to people never wanting to invest in commercial real estate again. I'd rather you buy a single and get on base and have it be a good deal for you that just becomes a stepping stone for finding that double or that triple or that home run, versus you getting in the batter's box your first deal, you completely strike out, you won't go back to the dugout, and you never want to get involved in real estate ever again. That's not what we want here. And the beautiful thing is, based on analysis, you can protect yourself in so many ways, but most people get overly optimistic when they're analyzing deals. That's not what we want to do here. I want to make sure that you guys are protecting yourself. And in this sheet, right, when we put all these assumptions in, then it gives us the ability to aggregate all this data into a deal summary sheet, and we get to view all of this information and go, you know what? Is this deal summary something that I feel good about? If I were to move forward and invest my hard-earned dollars, and based on the plan that I think I can execute on to bring all these numbers in this spreadsheet to life and to get to enjoy what I think I can extract out of this deal, we want to feel very comfortable and confident in this plan, in this deal summary. And so these are going to all be things that will tell you whether or not you've got a good deal on your hands. And again, for the sake of this training, I just want to give you a high-level overview. And one of the best things that I can give you are just some very simple analysis mistakes that newbies make. So number one is ignoring vacancy impact. A lot of people just assume, no, I'll never have a vacancy. Nobody will ever move out, right? No, absolutely. It's going to happen. And we want to plan for it, and we want to bake that into our numbers so that when it does, we don't go, well, I thought I was going to be 100% occupied the whole time, but now with these vacancies, my cash flow is 15% less, and that impacts the deal in a big way. Well, great. Let's plan for that in day one. Forgetting debt service coverage ratio. A lot of people don't, and for the sake of this, we won't dive into it too much, but a lot of people look at deals that the cash flow doesn't cover the amount of debt that you're going to have. And so you need to be at a certain cash flow coverage ratio to ensure that the cash flow will more than cover the debt and still have plenty of money left over for you to enjoy the returns that you're looking for. Overestimating exit value. This is one of the areas that most people go, oh yeah, I think in 5 years I'm going to be able to sell this building for this much. It's going to be crazy how much this building is going to be worth. And they put some aggressive cap rate on it when really I would love to see you underestimate that exit value and say, hey, if I hit that, we're crushing it. But if I don't, this deal still makes sense for me and I could live with that. Same thing on miscalculating your equity multiple and your IRR. That's going to be a more advanced one. We'll dive into that in future videos. Underestimating closing costs and loan costs, because guess what? That ties into the overall amount of cash you're going to have to put into the deal, which will impact your cash on cash return. So I want you to overestimate your closing costs, your loan costs, your holding costs, and account for that in the sheet. And guess what? If it comes in under, we're ahead. Underestimating CapEx. This is one where a lot of people go, oh yeah, that $500,000 renovation or the work that's going to be needed in this commercial property, I think I can do it for $300,000. And I think I can do it in 6 months. Well, really, I'd like for you to plan for $500,000 and for 12 months. And if you do it for the $250,000 in 6 months, but you plan for $500,000 in 12 months, guess what? You're winning on both of those. So another example of underestimate or overestimate where most people underestimate. And then just skipping the scenarios comparison. That's where you can get into, the nitty gritty and look at all the different scenarios and come up with some final version or a blend of one or two of those scenarios to give you the comfort in how you put your best foot forward on the final deal. So again, to wrap this all up, just use simple tools. Again, you don't need to be the expert that knows how to crunch all these numbers in your head or can go in and create all the formulas. No, you just need to know what inputs do you need to gather information for, where do they go, and then once I put these in, what areas am I looking for the outputs in, and do these outputs tell me that this is a good deal or not? right? And we'll dive into this in a lot more advanced detail in future videos. But for the sake of this training, I just wanted to get you guys in the driver's seat to understand that there's gonna be a lot of stuff that you don't know. And I don't want you to feel overwhelmed. I want you to start understanding that you're gonna have blind spots, and that's okay. The goal is to get you back into the driver's seat and at least looking at more pitches, stepping into the batter's box and seeing which ones do you actually want to take a swing at, right? And the way that you can do that is by analyzing your own deals, right? Or it's participating in this channel or other great channels, right, that are showing you real deal time analysis. That's why we do it in the Wise Investor Collective each and every month, to make sure that we're giving people real-time deal analysis access to be in proximity to what a good deal looks like and what a bad deal looks like, right? So there you have it. Deal analysis doesn't have to be overwhelming. And if it is, great. That's your call to lean in and start asking questions. Drop those down below. Don't forget to subscribe to the channel. And if this video did help you, share it with somebody that you know could get some value from it as well. Give it a like, drop a comment, and don't forget to check out the Commercial Real Estate Deal Analyzer down below. You guys can grab it down there. Until next video, we'll see you guys.